Panama is often discussed for territorial taxation, but territorial taxation is not a permission slip to omit information, falsify records, or improvise compliance. Panama's system explicitly draws a line between administrative evasion and criminal tax fraud using the B300,000 threshold calculated on the alleged evaded amount, excluding surcharges, interest, and penalties from that threshold calculation. The modern framework is strongly associated with Ley 76/2019, which approved the Código de Procedimiento Tributario and introduced a structured sanctioning regime for administrative tax infringements, while also defining how cases may move into the penal sphere. Under this approach, if the evaded amount is below B.300,000, the matter is handled as an administrative infringement by the Administración Tributaria. If the evaded or defrauded amount is equal to or greater than B.300,000, the matter can be treated as criminal tax fraud and competence shifts to the Ministerio Público. But it's not as simple as hit the number and instantly go to jail. There is also a procedural pathway. The tax authority investigates and develops the file. When the file indicates that the legal threshold for criminal tax fraud may be met, the procedure contemplates a formal process where an informational report is prepared and routed through the administrative tribunal track, including the Tribunal Administrativo Tributario, TAT. In that framework, the Public Prosecutor's Office does not begin the judicial criminal investigation without the procedural prerequisites and pronouncements required by the Tax Procedure Code structure. In other words, there is a pipeline, an administrative pipeline that can lead to penal referral when the threshold and elements are present. Let's talk about what administrative really means, because many people hear that word and assume minor. Under the administrative evasion framework, for example, in the context of income tax, the sanction can include a fine ranging from 3/4 up to 3 times the value of the unpaid taxes, that is 0.75x to 3x the tax allegedly not paid, which can be economically devastating in practice, especially when combined with the broader consequences that often accompany a contested tax file: interest, surcharges, enforcement measures, reputational damage, commercial disruption, and banking friction. The procedure also contemplates administrative consequences and enforcement measures. It distinguishes the penal sphere, where arrest is judicial, from administrative enforcement, while still recognizing that administrative outcomes can have significant operational impact. For repeat offenders in certain circumstances and under conditions, the framework contemplates temporary closure of an establishment as part of the sanctioning environment, again highlighting that administrative does not mean harmless. And an important procedural point: if a criminal route does not proceed because the facts do not meet the criminal threshold or requirements, the administrative process can continue under the administrative track based on the facts established. So a case does not evaporate simply because it does not become criminal. Administrative enforcement can still move forward. Now let's address criminal exposure at or above B300,000. In regulated sector guidance that cites the penal code framework around tax fraud, criminal tax fraud is described through conduct such as simulating, concealing, omitting, falsifying, or deceiving in the correct determination of a tax obligation in order to avoid paying all or part of the tax. When the amount defrauded is B.300,000 or more in a fiscal period, the penalties described include imprisonment from 2 to 4 years and a fine from 1 to 3 times the amount of tax defrauded. This is the point where the matter is no longer a tax dispute in the ordinary sense. It becomes a criminal exposure scenario with liberty and severe economic sanctions on the table. The same guidance highlights that where a legal entity is used in the conduct or benefits from it, the legal entity can face significant fines tied to the defrauded amount, described as not less than the defrauded amount and not greater than double that amount under the applicable conditions. In addition, related conduct, such as obtaining fraudulent exemptions, refunds, or improper tax benefits, can fall within similar penalty logic, again keyed to the same threshold architecture. The practical conclusion is straightforward. Once the conduct is framed as fraud, every participant, every entity, and every transaction can become part of the evidentiary picture. Here is where the discussion becomes real-world: the banking and compliance ecosystem. In AML-oriented guidance, Criminal tax fraud is treated as a risk relevant to suspicious transaction reporting and is linked within a broader compliance ecosystem that includes money laundering and organized crime risks. That matters because in practice, many people meet enforcement first through financial institutions, not through a courtroom. When compliance teams detect inconsistencies, they don't ask one question. They initiate a narrative audit. Where did the money come from? What activity generated it? Where is it earned? Where is it taxed? Do invoices match bank flows? Do contracts match the declared activity? Do transactions match the profile? If your story is inconsistent, incomplete, or constantly changing, the structure fails at the compliance level long before any formal legal process reaches its endpoints. And the idea that nobody enforces anything is also outdated. Public descriptions from the tax authority indicate that from 2019 onward, an internal specialized team was formed, professionals with procedural, administrative, and penal expertise, with ongoing training and interinstitutional collaboration intended to improve results and information exchange in the pursuit of offenses connected to money laundering, organized crime, and tax evasion. These descriptions also state that multiple cases of criminal tax fraud have been detected and referred to the penal sphere. Media interviews with officials have reinforced the practical point that the criminal figure is triggered when the threshold is exceeded, and that this legal framework has been in place since 2019. The point is not to dramatize, it is to remove illusions. A legal system built around thresholds, procedures, institutional capacity, and referral mechanisms is not a system that can be safely treated as optional. So, what does a serious, lawful strategy look like? It starts with understanding what tax planning is and what it is not. The tax procedure framework itself distinguishes lawful tax planning as not sanctionable, which implicitly highlights that fraudulent conduct is the target. If you want a structure that survives scrutiny, you must build it to be defensible on records, not just on slogans. That means clean accounting and matching documentation. Invoices, contracts, bank flows, and declared activity must align. It means a coherent and documentable tax position. If you rely on territorial sourcing, the source of income analysis must be consistent and supported. It means avoiding cosmetic compliance narratives where form is used to hide substance because procedure and enforcement are designed to test substance. And it means building a bank-ready narrative. Assume you will be asked for proof and prepare before you are asked. Let's make the threshold concept concrete with practical scenarios. Scenario 1. A small business starts by cutting corners and assumes it is harmless. The first period looks below the threshold, so the person feels protected by the word administrative. But the business grows, the pattern repeats, and the accumulated discrepancy becomes large enough to meet or exceed the threshold. Once the threshold is in play, the case can be framed in a different category, and the historical pattern matters. Scenario 2. When sales records, invoicing, inventory, and banking do not match, the delta grows fast and can cross the criminal threshold. Scenario 3. An entity is used as a vehicle, and the entity benefits from the conduct. In that case, exposure can extend beyond individuals to the entity itself, including major fines tied to the defrauded amount. The point is that enforcement is not only about one number, it is about whether the record supports intentional deception and whether the threshold and elements are met. Now, I want to be direct. Panama can be a powerful jurisdiction in the right context, but it is not a playground for deception. The post-2019 framework clearly separates administrative evasion from criminal tax fraud using the B300,000 threshold. Below that amount, enforcement is typically administrative. At or above that amount, the conduct can enter criminal territory with prison and severe financial penalties. And because criminal tax fraud risk interacts with banking and AML compliance, consequences can appear early. Account restrictions, enhanced due diligence, reporting risk, reputational harm, and transaction friction that can choke a business even before any court process is complete. If you want structures that work in the real world, you need strategy, not shortcuts. You need documentation, coherence, and compliance that can survive questions. If you want a case-by-case evaluation of a Panama structure from an asset protection and compliance perspective, contact my office at info@maurosavino.com. We will review the facts, identify what is realistic, what is risky, and what is defensible.